Hello, everyone. My name is Jim Bersicki. I am a business instructor here at Penn Foster, and I teach the financial accounting subject along with several other instructors. What I'm going to be doing is covering in this particular webinar chapters 4 and 5 in the textbook on financial accounting, which is accounting for merchandise business, and the inventory chapters. To kind of get started, I'm going to have to take care of some admin things first. I'm happy to see that you're here, but let me just kind of like go over some things. Hopefully everybody's hearing me. If you can hear me, just type something in the chat box so that I know that that you can hear me. Maybe put in your student ID number or something like that. All right. Okay, I see that people can hear me, and that's a good thing. I'm going to warn you that I am recording this here webinar. It's going to be 1 hour long, and I'm going to record this and put this webinar up on the student community so that you can go back and watch it again, and of course for other students who want to take a look at it. Now, and I'm going to handle this right now. If you're looking at the screen, you should see basically two images. And forgive me for a moment here, but what I'm going to do is I'm going to attempt to use my digital pen. Now, sometimes in the past when I've used my digital pen, things don't work so well in GoToMeeting. They have a pen that is part of their functionality, but I can't use the digital tablet that I have with that functionality. I actually have to use the mouse, and it's hard to write with the mouse. So let me play around here just for 1 minute. I'm going to scribble on the screen to see what happens. Okay, I see that there. And I'm actually going to erase it. Okay, and I saw that erased. All right, so I'm going to be using a digital pen in order to be able to write here, and this is kind of good. Nothing bad happened with the GoToMeeting. All right, so let me kind of cover these other aspects of the admin. If you're using GoToMeeting, I don't know how familiar everyone is with GoToMeeting, but if you have, I watch a lot of webinars by other speakers, and sometimes the attendees will say, I can't hear you, or whatever have you. If that's the case, or it cuts in and out, generally it's the functionality of the person's computer. And if you can't happen to hear me, then over here, if you're looking at your control panel, you see mic and speakers. Well, realize that you can click on telephone, and that'll allow you, give you a telephone number to call in, and you'll be able to hear the webinar using the telephone. And the other thing that you might want to pay attention to is in your dashboard is this orangish arrow key. That collapses your panel, which looks like this. Okay. But I kind of don't recommend that for the simple reason I have everyone muted right now. No one can talk to me. I can't hear anybody. So if you have any questions, type it into the chat box, okay? And as we go through this webinar, I'll constantly be looking at that chat box to see, if there's any questions that anybody has and that pertain to what we're talking about right at the moment. And then at the very end of the webinar, I'll actually open it up to just a question and answer session and try to cover any questions in that respect. All right, so let's move on here. I had said that chapters 4 and 5, which was accounting for merchandising for a merchandising business, and the inventory chapter, they have specific concepts in them. And to be honest with you, everyone who takes a business curriculum will actually, or the college curriculum, will end up taking math for business and finance, or they'll end up taking math applications. And in chapters 4 and 5, a lot of this material was already covered, all right, when in that math for business and finance subject. go back to chapter 7 and 18, and you'll be able to, refresher from the, math for business and finance. So these concepts really shouldn't be, anything new. All right. I do have this here web address here, and this web address is supplemental videos for the math and business finance. So if you go out to this web address, now this is on the student community, all right? So I have the student community. And under the student community, you'll see academic groups. And then under the academic groups, you'll see the business group. And on the left-hand side, going down the left-hand side, you'll see a section called Math for Business/Applications, okay? And you'll also see a section called Financial Accounting. Now, the Math for Business and Applications is a completed subject. It has supplemental videos covering the theory for those particular chapters, and also videos doing the assigned homework problems that were in the digital study guide. So if you're not getting stuff here in this textbook, go back to your math textbook or go out to the student community under the Math for Business section and review those videos. Also, too, you'll see financial accounting, right? And that's this here second web address here. Let me erase all of this. That's this second web address right here, okay, which is the specific section for financial accounting. And if you click on that, you'll see, it's right now it's a work in progress where we're actually going, chapter by chapter. So I'm actually working on the solutions for the assigned homework problems for chapter 5 right now, and I'm putting those up there. So you can go back to, go to that link or go to that web address, and you'll be able to view the supplemental videos to accompany the textbook. Now, I'm the person who is actually creating those videos, so what you're seeing in this particular webinar, is a kind of a spin-off of doing those actual videos. So, hopefully you've written these here web addresses down. I'll keep them up there just for a minute more. Realize that the only difference is this document number, okay, at the end. Then this way you can go out to the community and view those videos yourself. And again, that's student community, academic groups, the business group, and then down the left-hand side, it's either the math or the financial accounting. Right. So with that said, let me move on. Okay, now, as you can see, I have a blank screen. And the reason why I have a blank screen is because I want to talk about understanding an application. And if you've watched any of those videos out on the student community, you'll realize that every video I start out with, I talk about understanding an application, all right? I'm not going to repeat all of that, but what I do want to stress is the understanding aspect of it, right? From this perspective, right? When in chapters 1, 2, and 3, you basically did bookkeeping, all right? It was, getting the fundamental concepts of accounting down, what a debit is, a credit is, making journal entries, how to go through the accounting process. And you were going to create financial statements. You created a balance sheet and you created an income statement. Now, here's the catch. You're past, after chapter 3, you're getting into a point where you're going to start learning more and more detailed information, right? And you're going to be drilling down in that information. And those who are taking accounting as their curriculum, a bachelor's in accounting, you're going to keep on drilling down for the rest of your education into intermediate accounting, advanced accounting, right? But for most of us who are like in the business management degree, yes, you're going to have financial accounting and you're going to have managerial accounting. And yes, it's about understanding the overall concept and then filling in information. All right. What do I mean by that? Well, like I said, in the first 3 chapters, we learned how to create a balance sheet and an income statement. And on the income statement, you'd have a profit or loss. Okay. And that profit or loss gets transferred over to your balance sheet under retained earnings, all right, or a capital account if you're a sole proprietorship or whatever have you, right? So from an overall view, you have these here 2 financial statements, and realize that one financial statement affects the other. Now, in chapters 4 and 5, what are we doing? Well, we're actually kind of looking at the income statement, okay? And on the income statement in its most simplest form, we have revenues less our expenses, which gives us a profit or loss, okay? So theoretically, I can have just one general ledger account and call it revenue. And I can have a second general ledger account and call it expenses, right? And if I just have those 2 general ledger accounts, I'm able to actually create an income statement which would give me a profit or loss. But the problem with this here is that you can't analyze the information, right? So what do we have to do? Well, we create additional revenue accounts and we create additional expense accounts. For expenses, think about payroll expense, advertising expense, utility expense, rent expense, miscellaneous expense. Whatever expense accounts that you need, now all of a sudden you have revenue less your expenses, but now you have these additional expense accounts to give you a total expense right here, right? And if you had your revenue here, then we're able to say profit or loss, right? So what we've done is we've expanded the income statement. Well, we're doing the same thing with revenues, okay? And this is where we're going to start moving into what chapters 4 and 5 are about. In revenues, I can take, we've seen we can have a sales account, and then we can take, have a sales discount account and a return on allowance account. And that'll give us a total net sales amount, right? So now what we've done is we've created 3 additional accounts for revenue. And then out of this, we can say we have expenses, right? And whatever they are in order to get our profit or loss. So realize that all we're doing is just building one thing upon the other upon the other. None of this stuff is new once you've gotten past what revenues less expenses are. Everything else here is, it's just an addition to. It's just, a different way of looking at things. So if we have now this here idea of, oh, okay, I have a net sale, and then I take out my expenses. Well, the expenses, again, are advertising expense, utility expense. These are sort of like operating expenses, all right? They're the things that you do in order to run the normal operation of your business. But it generally does help for us to know how much money we make on something that we sell, right? So I can have a sale, and then the next thing we consider is, well, what is my cost of goods sold? In other words, what did it cost me to buy that item before I sold it? And when I sell it for, let's say I have an item that I sell it for $100 and my cost was $60, that means I have what's called a gross profit of $40. So now notice kind of like what just happened. We've expanded our revenue section even more, okay? We have sales, less discounts, less returns and allowances to give me a net sales. And then from our net sales, we can take out our cost of goods sold, right? So we can take out our cost of goods sold, and that's going to give me a gross profit. And then, and that gross profit is how much money we make on the item we sell before we start taking out the rest of our expenses. So when we take out the rest of our operating expenses, we end up with a profit or loss. So notice how we've just started expanding this income statement well beyond revenues less expenses, right, to give a profit or loss. So right now, at this point in time, this is the structure that you should understand, okay? And as we move into chapters 4 and 5, what we're going to do is we're going to start focusing in on just this one line item, cost of goods sold. And we're going to drill down into the information even more, because remember, we sell stuff, we get all of this data, we have these transactions, and we want to be able to analyze this information in order to make the best business decisions, right? And right now, what we're going to, chapters 4 and 5, we're going to be looking at the cost of goods sold. What makes up the cost of goods sold? Because remember, in cost of goods sold, if let's say, let's just say I have a clock, right? This represents a clock, okay? I could go out and buy the clock, and let's say I buy it for $60, and I'm going to sell it for $100, right? Well, my cost of goods sold is the $60, right? But I can also go and I can make the clock, right? And if I make the clock, maybe I can make it for $50. I'm still selling it for $100, right? But also too, I have to pay attention to what we're going to call our inventory, right? What we're putting in and taking out of our inventory, because when I buy it or when I make it, it goes into inventory. It's available to be sold. And when it gets sold, then I have to take it out of the inventory and I have to put it over here into the cost of goods sold. So when I have a net sale of $100, and if my cost of goods sold was $60, that gives me my gross profit of $40. Okay? And then I take out the rest of my expenses in order to get my bottom line profit or loss. And later on, for those that are in accounting, that's not actually your bottom line. I mean, you'd have to take into consideration taxes and stuff like this, okay? But generally, that's the idea behind what we're looking at as far as chapter 4 and 5 is concerned. We're looking at, how are we going to affect the cost of goods sold, and how are we going to affect our inventory? How do we account for it? And the reason why we do that is because you can't just say, okay, you can't think simplistic, meaning, if you watch my videos, you see I use the idea of a refrigerator, excuse me, and milk an awful lot. If you have a cooler or a walk-in cooler or freezer that has milk in it, right? Say, here's a carton of milk, right? And if you have, say, we'll just keep it simple, 3 of these, right? Yeah, you're going to purchase it and say, oh, I put those 3 in inventory, so yeah, that's what I have in inventory. And if somebody buys one, well, then it comes out of inventory, okay? But what happens to this one here that spoils? Maybe the milk is bad, okay? Or maybe someone drops that carton of milk and it breaks and spills all over the floor. Well, your inventory on your books shows that you have 2 because you sold this one. But reality is you only have 1, all right? So you can't look at inventory just from a perspective of what goes in and what comes out. You have to be able to take into consideration other aspects, right? Which now will lead me to the idea of a periodic versus a perpetual inventory. Let me get my pen again. So at the beginning of the difference between a periodic and a perpetual inventory. First of all, perpetual means ongoing. In other words, you start out with a beginning inventory, and then whenever you have a purchase, you make a change to the inventory. And whenever you have a sale, you make a change to the inventory. And that total inventory value gets updated every time that there's a change to the inventory. That's perpetual, it's ongoing, right? But that doesn't work in some situations, in a lot of situations. I mean, if you have something like M&Ms or a grocery store where you have a lot of stuff on the shelf, you know, think about this 3 gallons of milk. Yeah, you have the 3 gallons of milk in the store, but when one breaks, you know, you sold one breaks, you still have one on the shelf, but your books show that you should have 2. So what ends up happening is at the end of the accounting period, you actually take a physical inventory of what you have on your shelves, and you adjust your books to that value, to whatever your inventory value is. All right, inventory value. And so that's what periodic is. And you know, which one do you decide to use? Well, it all depends upon the business. If you're talking about a lot of small parts and stuff like that, you know, a plumber, a construction worker, you know, a tradesperson, grocery stores, you're going to have more of a tendency to use the periodic, okay? But if you sell cars, big items, you know, you're going to have a tendency to use a perpetual inventory, all right? I mean, it makes no sense to have a periodic inventory if you sell tractors or airplanes, right? You can easily count, you know, what you have, you know, on your car lot or in the warehouse or whatever have you, right? So that's why you would use perpetual. But when it becomes more difficult, you often choose to, you know, periodic, which means you go when you say at the end of every accounting period, I'm going to actually do a physical inventory, and I'm adjusting my books to that amount. Right? So that's periodic versus physical inventory. Now, as you can see, the formula here, you have a beginning inventory plus your purchases, and this makes what goods are available for sale. Now remember, what we're looking at here is we're looking at our books. Okay, we're not looking at what's actually in the warehouse. On our books, we start out with this beginning inventory, and then whenever we get invoices, you know, for items that we're going to resell, we're actually going to record those on our books, so we, you know, add in those purchases. So if I had $100,000 to begin with, and I purchased 25,000 more, that gives me 125,000, and I purchased 35,000 more, you know, now I'm up to 160,000. Well, my books are showing I have 160,000. That's what is available for sale, okay? But I know that that's not the value of my inventory because I probably would have sold some of these items. So my inventory value is probably less than 160,000 at that point in time. So that when we get to the end of the accounting period, that's when we have to do the physical inventory. And when we do the physical inventory, let's say my physical inventory is, let's keep things simple. Let's say my physical inventory ends up being 95,000, okay? So what I have to do is I have to subtract the 95,000 from what I have on my books, and that means I've sold, had stolen, lost, broke, you know, whatever, $65,000 worth of that physical inventory. And that $65,000 needs a journal entry. I need to take it out of inventory and move it to my cost of goods sold, right? So now that's generally what we're looking at for our cost of goods sold. So when you go back to, you know, the previous thinking on what our income statement looked like, okay, we had, let me do all of this. We had, you know, let's say we had sales of 120,000, okay, and my cost of goods sold now was 65,000, okay. Well, that's what it cost me to produce, you know, the product cost in order to produce those sales. So I end up with what here, 55,000, is my gross profit. Okay, and then from my gross profit, I take out my expenses, whatever they are, okay, and I end up with a profit or loss. Okay, so that's what we're looking at right here in order to translate into that number there on our income statement. So no longer is our income statement just revenues less expenses. Now it's telling us, oh, I have 55,000 that is available for me to be able, a profit to pay off my expenses. And this becomes important in aspects such as, let's say Red Lobster. And I like using this as an example because in Red Lobster, right, I know that the price of the menu changes depending upon the cost of lobster. And when lobster is plentiful, the prices in Red Lobster go down, right? And when the lobster becomes scarce, the prices go up, right? And the reason for that is because of this here cost of goods sold. Okay, they want to try to maintain a certain gross profit margin so that they know they have enough money to pay off all their expenses and still show a profit. They don't want to, they don't want to just sit there and say, okay, all lobster is going to cost $60 a plate of food, all right, all year long. That makes absolutely no sense because they'd lose business, especially when the price of lobster is down. So they lower their price and they might say, oh, well, when lobster is plentiful, we might make the price of our lobster $25, okay? Because why? We're going to sell more of it, and that'll maintain our gross profit to be able to pay our expenses, all right? So that's kind of like how that all works, all right? So I keep on checking, my question box here, and I see that nobody has any questions. If you do, go ahead and type in the chat box. I keep an eye out on it, and I'll stop where I need to. But where I'm sitting right now, I'm just going to continue on with the rest of this here presentation. All right. So in chapter 4, one of the other things that we come across is this idea of free on board that has to do with shipping. Now, why am I talking about shipping when I was just talking about inventory? Okay. Realize that on your income statement, like I had said, you have a cost of goods sold, and then under operating expenses, you could have a line item called shipping and handling expenses or freight expense or whatever have you. All right. When we're talking about the cost of our goods sold, if we have this here clock, and the clock costs us $60, okay? If we have shipping on the clock, and let's call it, say, $15, right? That $15 becomes a part of the cost of that clock. So the cost of the clock is $75, which is what ends up in our inventory. So when we sell it, that full cost then gets transferred over to the cost of goods sold. However, let's say we have, we make a sale, okay? And when we make that sale, now our cost is $75 here on that clock. But when we make that sale, let's say we sell it for $200, right? But we're doing it as, say, an internet purchase where we're going to ship to somebody else, right? Well, we might have to charge them, let's say we're going to charge them $25 for shipping and handling, okay? So the customer is going to end up paying $225 plus tax, all right? But this here $25 is not part of the cost of the clock. This $25 is part of our operating expense. In other words, it costs us $25 in order to make that sale of $200. So that falls under the category of operating expenses, whether it's a shipping and handling expense or a freight expense. So you have to be cognizant of where and when the freight comes in. And to that end, we talk about free on board. That's the terminology that's used by the shipping industry. And the important thing about this here is they have two different ways of looking at it. They have free on board shipping and free on board destination. And the big important thing is when title passes. Okay, I used to work for a refrigeration company that actually sold ice cream machines. And the ice cream machine would cost about $8,000. That would be the cost of goods sold. Okay, but when they sold it to the customer, they would sell it for $15,000, right? But they would all plus shipping. Okay, and this is where this idea of freight on board, shipping, and destination comes into play. Why? Because let's say this is the seller. This is, the company that's selling the ice cream machine, right? And the buyer is the store owner. Now, it's all negotiable as to when, how much shipping would cost. And let's just throw in, say, $500 in order to make it simple, right? Well, if we go and we say, the issue becomes when does title pass? For the simple reason that, as you can see for FOB shipping point, the title passes to the buyer, okay? And the buyer pays the shipping cost, meaning as soon as it leaves the dock and it goes on the back end of this truck, okay, that's when the title passes to the owner, the buyer, the store owner, okay? And they're paying for the shipping cost. Now, why is that important? Well, I've actually seen where in transferring that machine from the dock to the truck, or in the case of FOB destination, where the seller is paying the shipping cost and the title passes when, here's the truck at the store owner. When they're taking that off, I've seen that machine fall and get damaged. So now who's responsible for it? Okay, if in the case of shipping, if it falls off of the, if it falls off at the seller's place of business, the people who are selling the machine, generally the buyer is the one who's going to have contracted with a freight company, okay, to come to the seller's place and pick up that piece of equipment. So as soon as it leaves that dock, it becomes, the property of the store owner. And if it falls off onto the ground and gets damaged, and they're out $15,000. All right. Now, in the opposite case, if the seller, they have their own truck, okay, and if the seller is going to say, okay, we're going to pay for the shipping, well, if it falls off again right at the seller's dock, right, well, the buyer, he's not out the 15,000. He can say, hey, that machine is damaged. I don't want it. I paid for a brand new one. Give me a brand new one. All right. So, it's a give and take kind of thing, and it's all negotiable between the seller and the buyer as to whether you want, FOB shipping or FOB destination, for the simple reason it's not about the money. Okay. It's not about how much the freight costs. It's all about when title passes from one person to the other, okay? And of course, if my cost of goods sold is $8,000 and we're talking about the $500 in shipping, that $500 in shipping now becomes a part of the normal operation of the business. And so that would be, like your shipping and handling expense or your freight expense underneath your operating expenses. Okay, it's part of the normal operation of your business. So, I think they put this in the book, one, just to explain, that, but two, realize that it is not, when it comes to shipping, not all shipping is alike, and you have to, really pay attention to what's going on. Here I'm talking about, a seller and a buyer, but what if we added in a manufacturer? Okay. I mean, the manufacturer is the one who's going to make that ice cream machine, okay? And the manufacturer is the one who's selling it to the seller. The seller's the in between. They're the retail, all right? not retail, they're the wholesaler, and they sell it retail at the buyer. So when this machine leaves the dock at the manufacturer or it arrives at the dock on the seller, right, this is all part of the cost of goods sold. Because remember, I said this machine cost $8,000. And let's say part of that $8,000, let's say it's $7,500 plus the $500 for shipping in order to get the $8,000. So if it goes between the manufacturer and the seller, you're still talking about shipping and destination, but we're talking about being a part of our cost of goods sold. When the seller sells it to the retail buyer, right, now it's part of the normal operation of the business for the seller, and that becomes an expense to the seller. Okay, so you have, even though freight on board and shipping and destination is a common term, you have to really understand where you're at or who's involved in the process. If it's between the manufacturer and the seller, you know, that's a cost of goods sold. But if it's between the seller and the retail buyer, you know, that's an expense. Okay. All right, so that's covering the freight on board, and I see no one still has any questions, so I'm gonna just keep on moving on here. Right now it's 1:36, and I want to cover our inventory methods. Right. So, you know, we're realize that, you know, I was just talking about cost of goods sold. Okay, and that cost of goods sold is intrinsically linked, you know, to the inventory. But the issue becomes, how do we value our inventory? And we value our inventory in 4 different methods: specific ID, average cost, FIFO, and LIFO. Okay. Now, again, I covered these in depth in the math videos on the student community. So I'm only going to briefly cover these here, all right? Because especially for FIFO and LIFO, it does get into a lot of math. And they also have videos under the financial accounting section for these, all right? But realize that there's the 4 different methods, and there can be other methods. As accountants, if you're in the accounting curriculum, you'll realize that you can create different methods for different things, as long as you're able to justify them, all right? But those are the most common 4: specific ID, average cost, and FIFO and LIFO, because they fit into a lot of, you know, they capture most of the different types of businesses, okay? I see there's a question here that says, where go the transportation charges, to inventory or to delivery expenses? Okay, so let me back up here. Remember, transportation charges, it's this $500. So from the manufacturer, the cost of the machine is $7,500, and there's $500 for shipping, right? So the total cost of the machine to the seller is $8,000, right? It's likely that the seller will receive 2 invoices. They'll receive an invoice from the manufacturer for $7,500, which they will put that towards inventory. Okay, and then they'll receive a second invoice for $500 from the shipping company. And since that $500 gets associated to that particular machine, that also goes in inventory as part of the cost of that machine being $8,000. Right? So now we have this $8,000 in inventory, and when we sell it, okay, when we end up selling the machine to the retail buyer, okay, we're going to take it out of inventory and we're going to put it to our cost of goods sold. So that full $8,000 ends up in our cost of goods sold. So we sell the machine for $15,000, and our cost of goods sold, oops, let me erase this here. And our cost of goods sold is $8,000, which gives us a gross profit of $7,000. Now, as part of that sale of this $15,000 to the retailer, okay, And I know I get kind of messy here with all of my scribblings and everything, and I hope you all can just, work with it. As part of that sale of the 15,000, right? Let's say that the seller has agreed to ship it. In other words, we're looking at FOB destination, and the shipping cost is the $500. Okay. Well, when it gets shipped to the buyer, that $500 is going to go under shipping and handling expense or freight expense. And remember, that comes under the section of operating expenses. Okay. So in a simplistic way of looking at this shipping and handling of $500 would end up in our operating expenses, which would give me a bottom line of a profit of $6,500 on the machine. Now, obviously, we know that's not, that's not our total profit and loss, because we didn't take into consideration any of our other expenses. But I wanted, in answer to your question, where does the 500, where does the shipping go? Well, the shipping ends up going in two different places. It goes one over here as part of my cost of goods sold between the manufacturer and the seller, okay? And then we have an additional shipping charge, which has to deal with being between the seller and the buyer, okay? And the initial shipping here of $500 ends up being part of the cost of goods sold right here. But the second for shipping, okay, between the seller and the buyer ends up being down here, okay, as part of your operating expense, right? So they go into both different places, and that's why I started out this webinar by talking about, the framework and structure. If you can keep in mind the structure of the income statement, okay, and you start out with, that very, very basic, simple revenues less expenses gives you a profit or loss. Well, we end up actually expanding each and every section, and we're drilling down. So in order to learn this, associate with what you already know, okay? And you'll know where to put this stuff, okay? I mean, yeah, there's two different, we're looking kind of like at two different shipping and handlings here. Where does each one go? If you're buying it as a cost of goods sold, as a part of your product cost, all right, that you're going to resell, if you stick that under shipping and handling expense, that's in the wrong place, because it's part of the inventory cost, which ends up going to cost of goods sold, okay? It does not belong down here. But when you know what your cost of goods sold is, and as part of the retail sale, okay, if you have to ship, then it actually becomes a part of your shipping and handling expense. Why? Because on your income statement, you have, what's the definition of revenue? Revenues are what you sell during an accounting period. It's the normal operation of your business. And what are your expenses? It's, money going out in order to, as part of your normal operation of the business, right? $500 as part of the inventory cost is not a normal part of the operation of your business, okay? It's part of the inventory cost. Now, granted, it ends up being in cost of goods sold, and cost of goods sold is an expense, all right? And that's why revenues less expenses gives you a profit or loss, because you make the sale for $15,000, you have an $8,000 cost of goods sold expense, all right, which gives you a gross profit, and then you take out the rest of your expenses. So you're showing your full revenues and you're showing your full expenses in order to get your profit or loss. So understanding that structure, that framework, is important. Okay. Now, I know that in the videos on the student community, I don't go as in depth at that point in time, because remember, that was, if you were watching the introduction to accounting videos, covered the accounting cycle and things like that, and that's a broad overview. But realize that we are starting to drill down an awful lot more in our in our, picking up of all of this here knowledge, okay? All right, so I hope that answered the question. And let's quickly move on. It's 1:45. Let me just jump through these real quick. Okay, so I want to kind of like cover this here. All right, specific ID is about paying attention to what you actually buy and sell. I mean, the idea is here's a car lot, right? And you have maybe you have 100 cars at say $40,000 each, all right? Which means now you have 100 cars at $40,000 each. So you end up with $140,000, right? And if you buy 10 more cars, you're able to identify those cars, and let's say they're at $35,000 each. So that's an additional $35,000, $350,000. So that's 4 million. Boy, get my numbers right here. But anyway, so you're able to identify all 110 cars, so that when you sell a car, let's say you sell car number 94, and that car number 94 actually had cost $40,000. You're able to specifically identify that car and take out of your inventory the additional $40,000. And so you keep a perpetual inventory of those cars, okay? And the value of that inventory. And remember that, the reason why we're doing this is because, what you have on your, at your place of business for an inventory, the actual physical inventory is what's most important. Because again, you have theft and leakage and breakage and, damage and whatever have you, and that changes the value of the inventory because you can't sell that, those items. If you keep them on your books, then you start overstating your ratios when you do analysis, and that's part of the focus on decision making. At the end of each chapter, they talk about ratios and different formulas that you use to analyze your business. Well, if my physical inventory, if my books say I'm supposed to have 100,000 and I'm actually out on the lot and I have only 75,000, then I'm skewing my financial ratios, all right? And I'm not getting accurate information. So we always adjust to our physical inventory. If my book value says 100,000 and my physical says 75, then I have to make an adjustment of 25,000 to my books so that my financial ratios can be accurate, right? And that's the reason why we do that. All right, so that was specific ID. Average cost, and I have this here exhibit from the textbook. We start out here with a beginning, all right, inventory, and they're saying we have one item and the cost on that one item was $40, so my total inventory value was $40. Now on September 5th, we're going to buy 6 more and they cost $45 each, so my total cost is $270. Well, now I have 7 in inventory, and when I add the 270 plus the original 40, I have 310. Okay, that's my total inventory right there. But I had bought one at 40 and bought 6 at 45. If we use the average cost, what I do is I take the 310 and I divide it by the number of items in inventory, which is now 7, right? And when I do that, the average cost of my units now are $44.29, right? So anytime I'm going, I don't think in terms of, oh, this one item is 40 and these other 6 are 45. No, I think in terms of each item now is $44.29. So that when I go ahead and sell them, right, I'm selling them at, my cost of goods sold ends up being $44.29. Right, so as an example of that, we sold 4 of the items, so we had to take them out of inventory, okay, and we put them to our cost of goods sold. Well, how much are we putting in cost of goods sold? Well, we had figured out that $44.29 is the cost of those 7. So when we sold 4 of them, we're valuing them at $44.29, so our total cost is $177. And notice that when we take 310, which was our cost before and we subtract out 177, we end up with 133. So that's our new adjusted amount, our new inventory value. So the takeaway from this is that when you're doing average cost, if you notice that when we buy something, when we actually purchase something, we have to figure out the new average cost. But when we sell something, we don't, because we're using that average cost. So every time you make, if you're using average cost, every time you make a purchase, like in this case here, they're going to buy 7 more at 50. Well, my value was 133 before, and I'm going to add 350, right, which gives me the 483, right? But now I have 10 items in inventory, because why? After I sold 4, I had 3 left. I'm adding in 7, so now I have 10, right? So now I divide that total by 483, and now my average cost for all of those items ends up being $48.30. So even though these, even though we had valued these 7 items at $44.39 and these 3 were still at $44.39, when we do the new valuation, these 3 are no longer at $44.29. They're at $48.30, along with the rest of them that were at $50. They're no longer at $50. They're at $48.30. So every time you make a purchase, you end up having to do this calculation in order to know what your average cost is. Okay. Now, realize that it was very easy to say, okay, for specific ID, I can do a perpetual inventory. But we're talking about inventory methods, all right? Inventory valuation methods, all right? Specific ID is very easy because you're able to track specifically which items you're buying and selling. But with average cost, you're not specifically identifying. So yes, you're going to start out with a beginning inventory at the beginning of an accounting period, and you're going to have to consider your cost of goods sold, okay? And that'll give you a gross profit. So, what is our inventory value method that we're going to be using, all right? Well, depending, when we're using average cost, we actually still have to do a physical inventory of, and even with specific ID, you do a physical inventory just to make sure that you have all of your cars on the car lot and nobody jacked one, okay? But realize that when you do the physical inventory, again, we're back to, if my inventory on my books was 100,000 and I do the physical inventory and it says I only have, say, 90,000, okay, I have to adjust my inventory to 90,000, all right, based upon how many units I have, okay? So that would give me a new average cost. Yeah, we figured out that our average cost was $48.30, but we're adjusting to reality. So that's average cost. All right. It is now 1:53, and which means I have about 10 minutes. And I'm going to go over the FIFO and LIFO. And to be honest with you, with FIFO and LIFO, I really do highly suggest that you go back and you look at you watch the videos on the student community, because they go a lot more in depth, all right, than what I'm going to be presenting here. And I even in the in the math, they go into a lot of in depth and a different way of looking at it, and it's a lot easier to think for me in terms of milk and a refrigerator. That's the way I look at things. But I'm going to kind of like just briefly go over it real quick here. We have a refrigerator, and in the refrigerator, it's empty. And if I go to the store and I buy 5 gallons of milk at $1, okay, that means I'm paying $5. And if I open up the door to the refrigerator and I stick the 5 gallons of milk in there, okay, that means I close the door, that means the value of my inventory is $5. If I go back to the store and I buy 7 gallons, and that's at, they're at $2 each, right? Well, I'm paying $14, okay? And if I come over to my refrigerator and I open up the door, what I want to do is I want to think in terms of I push the 5 gallons to the back of the refrigerator and I put the 7 gallons in the front of the refrigerator. Okay, so I'm always pushing my oldest inventory to the back because why? They're the first ones that were in. Okay, the 5 gallons are the first ones in. The 7 gallons are the last ones in. Okay, so now when, that's, as you notice, that's half of the FIFO and half of the LIFO, first in or last in. The last half is what comes out, and you're taking, for last in, first out, first in, first out. So depending upon whether it's first in or last in, they're the ones you're going to take out. So if I end up taking out 6, right, I need 6 more gallons. Well, it depends upon whether it's first in or first out. If it's first in, I have to take the 6 out of the 5 that were put in first. Well, I don't have 6, so that means I have to take 1 more from the 7, and that means I still have 6 gallons of milk left in the refrigerator at $2 each, right? So my inventory value was $12. If I was doing the opposite and I was using LIFO instead, okay, if I was using LIFO instead, I want to take the last ones out first. So what were the last ones? The last ones were the 7. So I take the 6 of them out of this group of 7, and I'd still only have 1 gallon left at $2. And I have the 5 gallons at $1 for $5. So now the value of my inventory is $7. Whereas if I was using first in, first out, my value was $12. Okay, last in, first out, my value is only $7. And if I had an average, it would probably someplace in between. All right, I'm not going to go through the math here, but it would be around $10 if I was using average, costing. Now the reason why we have the different methods is it depends upon pricing. All right, how you want your financial statements to look. If you want your financial statements to look good, that means you want lower expenses, okay, which means you would use first in, first out, because generally older items are, you bought them for a less price, and when they get transferred over to your cost of goods sold, let me give an example here. If I sell something for, let's say, $50, if I make sales for $50, and if my cost of goods sold, right, is lower, let's say it's $20, right, I have more gross profit, right, of $30, okay. Well, that's using FIFO, okay, first in, first out, because my, what I'm taking out is probably less expensive because they were the first ones in. If I'm using LIFO, then I probably have $30 using LIFO, right? Because why? The items were more expensive, okay? So I'm taking out the more expensive out of inventory and putting the cost of goods sold. So now my gross profit would only be $20, okay? And why would you do this? Well, if I want to save money on taxes, I would probably want to use LIFO. But if I want to make my financial statements look great, meaning I have a lot of profit, then I'd probably want to use FIFO, right? So now the question now becomes is, which one do you choose when you set up, when you're first starting your books? You have to think it through. There is no set answer. It has to be thought through. And you can't change them willy-nilly. You can't say, oh, today I want to use FIFO, next accounting period I want to use LIFO. No, you can't do that. You choose one and you stick with it. Is it possible to change from one method to another? Yes, but based upon generally accepted accounting principles, the one you choose is the one you stick with. You can't just arbitrarily change. If you do have to change, you have to have a damn good reason for it. And big companies, I mean, we're talking big companies like Caterpillar, John Deere, Boeing, over the entire course of their business, they may make a change in their method. but they probably only, in the entire course of their doing business for however many years, they're maybe going to make a change only once or twice. But you're talking about a company that gets bigger and bigger and bigger, and they can justify changing that inventory method. If you have a small business, and you choose upfront FIFO, you're going to end up using FIFO for the rest of your business life. As long as that business, you're still in business. You're not going to change from FIFO to LIFO next year. Okay, if you do make that change, I mean, it is possible to do that. But then if you do choose, you make that change to LIFO, you're going to use that all the way through the rest of the time that you're in business. You're not going to go back and try to change back into FIFO at some later time. That violates generally accepted accounting principles. Okay, the gross profit method. All right, it's 2 o'clock, so we've been at this for 1 hour, and I'm going to just briefly go over this and then field any questions because I still don't see any questions here. From the gross profit method, all right, now remember what we're talking about: revenues, right, our sales, less our cost of goods sold, right, giving us our gross profit, right? Now, what does, and the reason why we're calling this the gross profit method is because we're looking at gross profit here. But how do we get our gross profit? Well, we have to deal with our cost of goods sold. And the formula is, we have beginning inventory, and then we have our purchases plus purchases, right? And that gives us our goods available for sale, okay? And then out of that, we actually do the physical inventory, all right? And that gives us our ending cost of goods sold, okay? Which, which should coincide with our inventory methods. I'm going to bounce up some slides here, and we're kind of like looking here at the gross profit method, all right? So, I covered this on the first slide, but we're coming full circle here, okay? So that you realize, where, I hopefully you're following along, and right now you're kind of like saying, okay, this all, falls into place, okay? So I don't really need to cover much more about the gross profit method, because that's what we've been doing all along, is we've been sitting there saying, okay, how are we dealing with, our cost of goods sold, and how are we dealing with the valuation of our physical inventory, all right? All right, so focus on decision making, right? At the end of each chapter in this textbook, they're going to have the section called Focus on Decision Making, which are going to be our ratios that we're going to use to analyze the business. In chapter 4, these were the ratios: earnings per share, gross profit percentage, and net income percentage. Notice I also have here math for business and finance. These were covered again in that math textbook, right? But I do realize that we have some students here who do not, they can take financial accounting as a single subject, and so they might not have had math for business and finance. And that's why I said go back and watch the videos in the math. And I actually did some separate videos in the financial accounting chapter 4 section, on the student community, covering these here ratios, all right? The important thing here is to know that earnings per share is exactly what it is, earnings per share, right? Earnings divided by shares, earnings being your profit or loss, and your shares being how many shares of common stock you have. But I want you to realize that this earnings per share calculation, just like all things in financial accounting, we can dig deeper and deeper, okay? This is just an overview. It's a very basic, quick, down and dirty ratio. It actually ends up being 3 blackboards long if you're doing, if you get to intermediate blackboard. If you're an accountant and you go into intermediate accounting, this earnings per share calculation ends up being 3 blackboards long, because of just adding additional information. Now, for the gross profit percentage and the net income percentage, it's very easy to remember this. notice what's in the denominator, right? It's gross profit divided by net sales revenue and net income divided by net sales revenue. So if you remember, these two, in order to remember these two percentages, just remember in the denominator, they both have net sales revenue. And remember, net sales revenue is sales, less discounts, less returns and allowances, okay? That gives you your net sales, right? So that's what goes into the denominator. And what goes into the numerator? Well, what is it, if you're being asked a question and they say, oh, I want to know what the gross profit percentage is, well, they said gross profit. Notice that's what is in the numerator, okay? And if they said net income, notice that's what is in the numerator. So remembering the formulas, should be pretty easy, okay? But do realize, and I'm going to show this on the next slide for chapter 5, that it's, you don't take things for rote. You can't just look at the example in the book. I mean, sure, the book provides examples, but I had a student just a little bit ago who called up and said, they have grades of 90s, and they ended up, getting a very, very poor grade on their proctor exam, their final exam. And it was like, well, why? If you have a 90, just by retention, you should have gotten like a 60 or 70 at the very least. Why did you end up with a very poor grade? Well, that's because you didn't study, and when you were trying to do things, you were trying to copy it exactly out of the book, okay? And that's not what accounting is about. Accounting is about understanding the concepts and applying the information to the situation. In chapter 5, we have these two formulas, inventory turnover and days sale in inventory, okay? Now, the inventory turnover is cost of goods sold divided by our average inventory, right? And in order to get our average inventory, we have this here formula, beginning inventory plus ending inventory divided by 2, right? So the point I'm trying to make here is that, the book is going to give you specific information just to illustrate the concept, okay? But realize that, I've been talking about cost of goods sold now for an hour, okay? And if the situation says our cost of goods sold is, 35,000, okay, and my beginning inventory is, say, 30,000, and my ending inventory is 50,000, all right? 30 plus 50 is 80, and I divide that by 2, which means my average inventory is 40,000. So I take the 35 and I divide by 40,000, and I get, whatever for an inventory, turnover ratio. But realize that that's being given information directly related to solving the problem here. But when it comes to these ratios, you're not always going to have easy information, okay? You're going to be given a lot of different information that you're going to have to add and subtract in order to arrive at what you need to know to be able to calculate your particular ratio. None of your problems, well, I can't say none because I just gave you one, but if they're talking about the problem could say something like you have sales, net sales of 100,000, and your beginning inventory is 30,000, your ending inventory is 40,000, and now all of a sudden you have to start figuring stuff out. You can't just look and say, okay, what's my cost of goods sold? Oh, here it is, 100,000. No, that's your net sales. That's not your cost of goods sold, right? You have to go back through everything that I've talked about in this webinar and what's in chapters 4 and 5, in order to arrive at the numbers that you need in order to be able to do the ratio analysis the correct way, okay? And days sale in inventory, all right? It's your average inventory divided by your cost of goods sold divided by 365. So it basically looks like this. Your average inventory is over, and then you have cost of goods sold over 365. And I see students make a lot of mistakes here in that they don't do the math in the denominator first, okay? They kind of like just read across and they take the average inventory and then divide by the cost of goods sold, and then they take that and they divide by 365. If you just go straight across, you're going to get that wrong, okay? You have to realize how the formula is created, and you have to do what is in the denominator first, that mathematical calculation, come up with a figure and divide that into your average inventory, right, in order to get your day sale in inventory. Okay, so that's it. We're at 2 hours and 10 minutes. I'm sorry, 2:10. So we've been at this for an hour and 10 minutes. And I'm going to open it up to questions and answers. Go ahead and type them in your chat box. And if we have no questions, then that'll be the end of this here webinar. Okay. So I'll wait just a few seconds here to see if anybody has any questions. But if not, it was hopefully you got something out of this here webinar, and it made a lot of sense to you. And again, if not, I'm going to put this webinar, like I said, I'm recording it, so I'm going to put this up on the student community underneath the financial accounting. And let me kind of like direct you again to what's on the community, or where to go on the community, just in case you didn't get it. All right. So these are the web addresses on the student community. This first one here is for the Math for Business and Finance. Like I said, watch the videos for theory in chapter 7 and 18. And this one here is for financial accounting. Okay. Right. So that's the web address in order to get to that section for the supplemental videos on the student community. And if you happen to log into the student community, all right, you go under academic groups, and then you choose down the left-hand side, you choose the business group. Okay, and after you choose the business group, down the left-hand side of the page, you'll see the Math for Business / applications. And you'll see a section called Financial Accounting. Okay, if you drill down into those sections, you'll see all of these supplemental videos that I was talking about. Okay, since I don't have any questions up on my board here, I appreciate everyone being here, and we're going to call it a day. Now, I am most likely going to have a free-for-all webinar, meaning you can ask any questions that you want on any subject in the textbook. I'll probably have that next week. All right, and then I'm actually going on vacation after that week, so it'll be like in 3 weeks where I may or may not have another video and move on to chapters 6 and 7. It all depends upon what I've got going on for work here, but just realize that next week most likely I'll have a free-for-all ask any question you want financial accounting webinar. So thanks for attending, and good luck in your studies. And if you don't understand something and you still have any questions, feel free to contact an instructor either via email or telephone. All right. With that said, everyone have a good day.